Hello everyone, this is Aldo Lagrutta, and today I have something truly invaluable for all the day traders out there. We're going to be showcasing a recording of a live masterclass that my father very passionately delivered to the members of the Technical Analysis Institute on how to use Renko bars. Now, whether you're a day trader, an intraday trader, or a swing trader, this video is for you. It is designed to refine your technical analysis technique and provide a comprehensive guide on how to effectively trade with Renko bars. My father's insights, which have been cultivated over many years, are a real treasure trove for anyone who is serious about making their mark in the trading world. Let's dive in.
Several of our regular members missed the important lesson on Renko bars. I was checking on last lesson on Renkos and was a couple of months ago. So what we're going to do today is review our past lesson and then move a bit farther on trading with Renkos and the use of them. So those of you who have already been using them can also take advantage of the class and ask any questions and tell me any difficulties that you have been encountering with it. In my opinion, Renkos are relatively easier to use than candlesticks or bar charts, even though those are the ones we use. But we use them primarily for wave analysis. In fact, we use them at different stages. Although we haven't covered candlestick charts, we will be covering them, and we covered bar charts, and we use them for wave analysis. And then when we want to use candle analysis, which we also do obviously, then we move to candle charts. Now, Renkos have not been known in the West for a very long time. In fact, it was only until 1990 when a very gifted analyst by the name Steve Nissen published a book. And if you're interested, it's not that it's necessary, but if you're interested, the name of the book is Beyond Candlestick. And in that book was where he introduced traders in the Western world to the concept of Renkos. Now, there are three reasons why I'm teaching you Renkos and even repeat the class. The first reason is because, well, obviously it must be part of your general knowledge as a decent, well-educated technical analyst. And while you don't have to be an expert on all charting styles, it is important to know them and to know how to use them and to know in what situation is best to use them so you can continue being active and having clues from charts that otherwise you wouldn't have. The second reason is because I believe that you will find them extremely useful as part of your trading tools. Some of you may even find them profitable, and as a very minimum, you'll be able to use them for short-term operations or even for exits, because they're especially good to save us at the time of deciding where or when to exit when we have wave counts that are not completely clear. And the last reason is because it will help you understand better a tool that I consider to be one of the most important ones in my trading arsenal, and of course that I want you to learn well. And I am referring to point and figure, and as you know, we'll be covering point and figure in our next intensive. Now, the chart that you have in front of you is a Renko chart, and that particular one is combined with our top indicator. Okay, so when you look at that chart, you will understand why I'm recommending this type of chart for your short-term trading. So I know basically this one is a, what is it? This is a dollar. Okay, so all the charts are looking like that. I'm not choosing the dollar for specific reasons. We can check the euro, for example, and you'll see pretty much the same type of picture. It looks, well, it looks fantastic, because if you notice from here, that's approximately 114.60, let's say. And from there all the way down to, I think it was 111 something. Let's see. Yeah, 111.20, right? Well, from there was practically nothing that led you to have any doubt about the trend. So that's why they look fantastic. But trading with it is not as easy as it looks. So I beg you not to fall into the trap of thinking that because the way they look, you will never lose a trade again or anything like that, because that's really not the case. There are certain things that will be a lot easier with Renkos, and I will show you some situations where Renkos may have saved you or given you an opportunity when we saw no opportunities in the normal charts that we use. Okay, Renko charts are cleaner. They eliminate the noise that typical charts have, essentially behaving like a line on close chart, because there is no noise in there. But they are not a panacea. Let's have that clear. Okay, you will have the same risk. Perhaps you can reduce the risk a little bit, but in other words, you're going to have the same type of situation in which when you take a trade, you don't know if that trade is going to continue, if it's going to continue in that direction. So you have the sort of the same risk, even though your stops may be smaller. But you will have similar disadvantages that you would have trading with bars and with candles. This is definitely not a substitute for correct analysis. Okay, and now ideally, in your case, since you are learning and have learned different types of charting strategies, you will use them in combination with other chart types. And in my nagging role, I would say always, but always in combination with your wave analysis. If you want to be to create those 3 C's we always speak about, if you want to trade with calmness, with confidence, with certainty, you need to always include your wave analysis. Even when your wave analysis is not completely clear, you have an idea of what is not clear and what you could expect. Now, having said all that, Renkos may be much better at identifying the trend and helping you stay with the trend than any other type of chart. Well, maybe not any other, because you will see that the best point and figure. But if you get to use, if you get used to, let's say, if you get used to use them in a way that you make them work for you, they are much easier, because you don't have to interpret a lot, like when you use candlesticks. When you use bars, you have to know where it opens, where it closes, the type of bars, if it is an inside day, if it is an outside day, if it is an inside bar, if it is a 3-in-1, if it is a reverse 3-in-1, etc., etc. But of course, Renkos have much or many more advantages, let's say, than simply identifying the trend and having a chart that is absolutely clean. They make the levels of support and resistance, and even the corrections, they make them a lot more evident. So let's give you an example. We can give an example here. We can use any chart. Let's take the next one. Okay, so let's look for, well, first one. You can see level of support here. Look what happened. Okay, let's put a line there. Just a second. Let's use it a horizontal line. Now I don't find a line. Ah, here it is. No. Okay, I don't find a horizontal line. Okay, let's do it like this. See this? How this level here work as support? Well, yeah, remember, support or resistance is not a line, right? It's an area. And you can see this area here, how it works perfectly as support. You can do exactly the same with this one. Look at this one and look what happened later. If we had a line that worked better, would be even better. Well, let's look at here. Look at what happened here. This area of resistance, look how the area of resistance remained there again and again and again, right? So the entire time, and the same thing here, and look how that repeated itself several times. And notice how this one, remember the first one we traced from here, that was resistance before, was support before, and you can go on and on like that because it's always the case. Look at this. This area of support here, that was what stopped prices in all this area. They are extremely obvious and extremely um, useful because you have a very accurate idea where prices may stop. So when you have a large decline, you have a previous support there, a previous historical support there, you know the area where price likely will stop. And if they are not stopped, like for instance here, this was an area of support and it was resistance here, but it got penetrated. When that happened, then you have a very good chance that the signal is a good signal to buy. So they make the levels of support and resistance very obvious, and you can see that the corrections, of course, we cannot really identify the type of corrections that are happening here as we do with our typical bar charts, but we can identify how this has been correcting for all this time, and we need to wait until that ends before we can participate. So the second advantage is that they are obviously better at catching the large move by filtering out some minor price fluctuations that otherwise will make you panic, that will make you doubt, will make you even exit trades, because winning trades, because you were uncertain of what was going to happen. And so making when you use Renkos charts, it makes the overall sentiment of the market much more obvious. So for instance, let's say that you are going long and being long here. Well, notice there is not a single bar that is going against the trend, right? So you know that the sentiment here is bullish. So you don't really want to exit this market. You don't have the doubt. You actually have a confirmation that this is bullish and I'm going to stay. So if a trader wants to determine if there is a continuation in the sentiment, observing several breaks would indicate that the market has the ability, in this case, for instance, to push prices higher, right? And let's look at the first one we were looking at because it had two directions. In this case, pushing the prices higher, right? You can see that very obvious, and in this case, pushing the prices lower. So let's say that visually, it gives you an immediate sense of the sentiment of the market. Do you remember the second tenet of technical analysis is prices move in trend and trends tend to persist? Well, Renko will make a much better job at keeping you with that view, keeping you in the trend without starting to think, should I Should I exit? Should I not? Lastly, well, there are other advantages, and certainly I think Renko are much better than other strategies, including candles, bars, and even point and figure, when we are talking about assisting you in determining the time to close um, or exiting winning positions without the risk of turning a winner into a loser. Because when you use candles of bars, let's say that we are trading currencies, and we know that they can move, particularly if you are trading currencies in smaller time frames. You know that they can be very volatile. So when you are using candles or bars, they don't generally offer you a price target, unless, of course, you make projections based on previous levels of support and resistance, or you make levels based on Fibonacci projections and relationships and wave analysis. So what happens is that you may be in a, let's say, very good position, you know, uh, related to your time frame. It maybe it's a super winning position, and you don't know when to exit it. So you find yourself seeing all your profits going away because you don't know what to do. And the reality is that we have all done that. I mean, it's not the first time. I have I have consulted with people that told me I had 100,000 into the trade, and then I ended up the day 100,000 negative. So that happens. So, and that's because you don't have, or because the trader doesn't have a clean, clear exit strategy. And that doesn't happen when you use Renkos, because the signal to reverse triggered by this type of, let's call it charting, can be used to close out a position that you were uncertain where to exit. And doing so, not losing a lot, but keeping relatively most of the profits that you have gained. I'm going to give you a recent example in euro, and it's a very good example because it shows us how we didn't know what we were uncertain while using a wave analysis, and we didn't know if we should go long. In fact, I told you repeatedly that we couldn't take advantage of that based on the information we had. And yeah, let's use this chart, and I'm going to remind you here what was happening. Well, let's use this one. You probably remember that we had this 1, 2, 3, and we were thinking this was a 4, and maybe this was a 5. But as Gerhard clearly recognized, this was an A, maybe a triangle here for B, and then C. So it was more of a C, of a ABC leg rather than 5. So we were uncertain. Is it going to go long or what? So how do we take advantage of that? Well, we couldn't take advantage of that with that information because we had, well, let me go back. Because we had several count possibilities. We were like, well, what if this is 4? Let's put this 4 here, and this is 5. Well, then the next move will be 1, 2, 3, 4, 5, blah, blah, right? But what happened if this is an A and this is a B, and then the C was going to be a part of a triangle, the D, the E, blah, blah, and then another move down. So we couldn't take that risk, right? And then we had the other possibility that I mentioned today. Maybe this is an A, maybe this is a B, and now we can see 5-wave move there. Maybe this is a C, and maybe it's complete, or maybe pushing a little bit higher, but it already fulfilled the minimum requirement for that. And this is the 4, and now we get the 5. That is possible as well. So the fact is that if this is a 4, the next move will be down. So with this information that we have there, there's no way to take advantage, right? And so I went ahead and tried to label that clear 3-way move that Gary pointed out, we agree, of course, that this looks more like an A, B, and a C. But if, let's say, if in case that this continues moving higher, and this was the one of a larger degree, then I tried to see if there was a way to explain the 5-way move down, and there is. Not a textbook way, but a very, let's say, acceptable way. You can see here, this is very impulsive, this is very corrective ABC here, and now here we can say 1, 2, 3, 4, and diagonal 5 for 3, right? And then diagonal 5 of 3, and then 4, and then here you can have clean 5 legs. So it is possible. But we still had it out, right? It could be that, or it could be that it was an ABC. So should we go long? And with this information, we couldn't go long. Now let's see with the information that the Renko gives us. And you can see how even in those situations where we are in such a doubt, we can go long. See what happened? This is the decline, the 3-way decline, went all the way to 111, 20, but in this case 39. You will understand why in a moment. And then it gave a buy signal right here. So that's a very good profitable signal. So whether we were certain of the direction, this is a valid signal that we could have taken when we are in a situation where we don't know exactly what the count is. We know that the next move will probably be in that direction because, well, in this case, because we spoke, let's say, we knew that if we had an A, a B, the move up had to be a C, right? If it is a triangle. If it is a flat, it's going to be a C up. If it is a 1, it's going to be up. So it didn't really matter what happened. Once at this level here is penetrated as a 1, 2, 3, the space is free to move higher, right? So with that in mind, notice how we don't know what it is, but we do know we have some idea of the direction. And then we know that the signal could be taken with certain degree of confidence. And now we know where do we exit it. Let's say that we were short here. And we had the same situation because remember we were expecting 110, right? Well, it was 110.03, but let's say 110. Now, we are short here, let's say, and we're expecting 110, and now it comes here, and then we see 2 bricks moving in the opposite direction. Notice that from here to here, these are over $2 worth of trading, and there's only 1 bar reverse. So what does it tell us now that we have? Well, we see 1, we see 2, we see 3. Well, obviously this is a major situation here, right? We better get out of here, because even if it goes back down, then we can take the breakout of this one, of this support, but it makes no sense to risk the fact that this could go completely down and have all those profits, and then could retrace completely and lose all those profits. See what I mean? With the Renkos, it's very easy. You see, for instance, in this case, we see that, let's say that the typical is 1 bar reverse, or let's say 2 bars reverse. Well, when you are to determine your exit, you use that into consideration and say, well, I'm going to exit with 1 bar or 2 bricks or 3 bricks, whatever you decide. But you already have a very clean idea that you're not going to let this thing go into 5, 6, 7 bricks with the hope that it's going to change or that it's going to reverse. You see what I mean? That's why this type of bars can be a lot easier than bars or candles, because it doesn't give scope to that. Doesn't give you room to start thinking about should I not, right? Let me check your question because I haven't checked them yet. I have such a bad habit of just going ahead without. Okay. What are the green candles? Okay, I'll tell you in a moment. In a moment. When we'll end up our lesson about the MACD? Good question. I'm so glad that you brought it up. How about we do it the next technical session? I will put that in the schedule for the next one. Okay. And apologize for not keeping the track. It's only that we started with it, and there were other things that were important, and then I went back. I did not forget, but you are absolutely right and correct. We will continue with them in the next session. All right, it's a promise. Um, yes, it takes getting used to them. Yeah, it's not that easy. It looks very easy, but it takes a lot of practice. In the beginning, you get worried because there is less information. Absolutely, absolutely. That's why I say, you know, you don't have the you don't you have to get used to trading with them, or you have to get used to the let's say the time frame. So, or simply put your orders and your stops and leave it, leave, let it work, because otherwise they can be psychologically difficult. Because, well, let's continue. Let me explain more about them, and you will see why. Well, as I was saying, the signals with Renkos can be used to close out a position that we are certain where it's going to go and where to exit. And we do that keeping a lot of the profits, because two Renkos, when you have 20 Renkos in profit, is really nothing, right? 3 Renkos is really nothing when you have 20 Renkos in profit. And it's not rare to see 20 Renkos in profit. Okay, so now I've told you all the advantages and even how to exit. But I haven't told you the basics of Renkos, how the charts are produced and all that. They are like candlesticks. They were developed in Japan, and they're similar to our point and figure charts in the sense that they don't take time or volume into consideration. That means they take only price into consideration. And so that means that in a time chart, let's say it's a daily chart, so to speak very generally. In a daily chart, a bar is formed every day, and it doesn't matter what happened during the day. It doesn't matter if there were many contracts exchanged, if there was a lot of volatility, if there was a lot of volume. The bar is going to be produced the next day, regarding um, how much the price changed. So a bar is going to be formed every single day. That's the daily chart. So every bar or candle represents whatever happened during that trading period. In other words, if we're using a daily chart, every bar represents 1 day of trading. But in a 2-hour chart, every bar represents the action that occurred during the past 2 hours. I will explain more about candles and even teach you some candle patterns that are extremely useful for our analysis. I would say for as a way to supplement our analysis, because it gives us more clues. But that won't happen in the next few days, so we'll still have to wait a little bit for that. But you will also get that. So I'm not going to explain now how the candles work, but we can use as example the bars, and you know exactly how it goes. But the constructions of Renko bars is different because, as I said, it doesn't take into consideration time. So they only reflect price. In that sense, they are exactly like point and figure, and that's one of the reasons why I wanted you to get introduced to Renkos, because you would get familiar with only price action, independent from time, and that's a major thing that we need to know and understand before we learn point and figure. And regarding the name Renko, people say this and that, and God knows what the truth is. I don't really know the meaning of the word Renko. Some people say that the direct translation is love, but love chart doesn't sound. That sounds a bit weird. Of course, it sounds very cool if you fall in love with this type of charting. And majority of books say that it comes from the word renge, which means break. Well, if that were the case, probably this wouldn't be called Renko charts, but renge charts. But anyway, it doesn't make sense that we use the word Renko charts, because that means break, and the real word of break is renge. But the concept is extraordinarily simple. It's truly basic. A bar, which in the case of Renkos are called breaks. Each break is placed in the next column once that it surpasses the top or bottom of the previous break by a predefined amount. So there can never be more than 2 bricks in one column, and that's one of the rules. Okay, so you can see here there is single brick in every column. There is never one brick on top of the other. And that's one of the rules that this type of charting has. And another rule is, what's the second rule? I forgot. No, it's very simple, that there can never be gaps. So all bricks will always be touching. So let's say that this was 111.50, let's say, and the market gapped all the way to 112. Well, there won't be a white space here. All these bricks will be printed, so you won't see any gap there. It is thought to be named after the Japanese word for bricks, renga. Yes, that's one of the explanations that people give. But why are they called renga, which is a Japanese word? And I'm sorry, why are they called Renkos, which is a Japanese word, instead of called renga, which is a Japanese word? So that's the reason. All right, so 2 rules, right? No gaps, and all the bricks will be touching, and there is only 1 brick per column. Now, let's use this example we have in front of us. So this is the euro, okay? And on this chart, we are using 10 pips to form each brick. Each Renko bar basically means that every time that prices move 10 pips in one direction from our last brick, then a new brick will be formed. Okay, for example, let's say that here it goes, let's say that it goes from, let's say 111.99. Well, that's a bad number. Let's start from here. This is from 112.20, and then the next one will be from 112. Because this is a 2. Let me change this. Let me change this very quickly. But it doesn't matter. Let me continue with this example. This one is a 20 pips, okay, instead of a 10. So basically, every time that 20 pips are formed that go beyond the previous brick, then there will be a new brick form. So let's say that we go from 112.20, and this will be, the top here will be 112.40, right? So now price can go to 112.50. Nothing will print. One could go, price could go to 112.10, and nothing will be printed. Nothing will be happening. It is required that this brick to be printed, it is required that prices move to 112.50. 112.60 or beyond that. Say that it moved to 112.61. Well, it will print this bar. Let's say that it goes to 112.65. Well, it will print only one brick. Let's say that it goes to 112.69. Still, will print only one brick because the minimum requirement that we have to print the bricks are the 20 pips, right? Does it make sense? Maybe I should give you an example with a clear, a more round number. Let's talk again about the 10 pips. Maybe it's easier. Okay, we're saying that prices need to move 10 pips in one direction from our last brick to form a new brick. And this means that if euro moves, let's say 7 pips in a given period, let's say 1 hour, the new Renko brick will not be formed. If euro moves 9 pips, no new column will be started because there are not enough pips to form the new brick. And if we were using a candlestick chart, it will print a new candle for the next period, even if prices have not moved at all, right? But in Renko, a new brick is only added when price movements completely fill the predetermined brick size. Now, you may say, well, how do you choose that brick size? Well, that's up to you, really. I will tell you in a moment how do we choose them, but it's really up to you. It's a matter of with what type of brick size you feel comfortable, which is again one of those things that I was telling you before. It takes a while to get used to this. So let's make sure that you have understood. Let's say the brick size is 10 points, okay, and the last brick covers prices of 20 to 40. Now, the new brick won't be formed until prices close either at 50 or above 50, right? But if they close at 49, there won't be a new brick. If they close at 49.99, there won't be a new brick. And that's what Esther found difficult. On the other side, on the downside, they will need to close at or below what? We said 10, right? So they will need to be at 10 or at 9 or at 8. But if they are at 11, there won't be a new break. Now let's say that prices close above 50. For example, 55. The new break must still stop at 50 and only produce another break when prices closes at or above 60. Of course, using the example of the 10 pip break size, right?
Hello, it's Sidi again. Just a quick pause for something incredible. If you are serious about mastering technical analysis, then don't miss out on our Technical Analysis Mastery 114-day course. It is an absolute transformative journey for any trader. Interested? Then click on the link below for further details. Also, if this lesson has added any value to your trading knowledge, let us know in the comments below and share some love by clicking on the thumbs up button. More importantly, don't miss out on any future expert insights and subscribe to our channel. Let's continue.
Can we change for 10 pips per break? Absolutely, it's very easy. I'll show you in a moment how to do that, but let me do it here in a moment, and then I'll explain later how to do that. Here's a 10 pip break. Okay, so the breaks that form above the previous break. Let's say this break is above this break, right? So when a break forms above this break, we call it an up break. And the ones that form below the previous break are down breaks. It's just terminology, not really important. And you can sometimes see bricks with lighter colors, and that's the question that Adrian had. That typically happens in intraday charts. So if prices are moving higher before the closing price, the software won't print the bricks, because let's say that we chose a 10-minute time frame, and you say, well, but you said it didn't have anything to do with time. Yes, but the bricks are calculated with the close. So in order to calculate if the brick closed 10 pips above the previous brick, the previous brick, you need to wait for the 10 minutes, right? Otherwise, it could go up, and what if it goes back down? Then so you have to wait for that. So what the system does is to print lighter color um, bricks. Okay, it makes it light green, or light blue, or whatever, or light red if it is to the downside. Now, if that bothers you, because it may, otherwise ask Esther that already did her homework and tried. If that bothers you, then you need to use a smaller time frame. So this approach, is that clear, guys? It moved 50 pips in 1 hour. Will print 5 bricks or only one? Well, it depends on the closing time. Let's say that it moved 50 pips in this case. It moved 50 pips, and then it will print 5 bricks at once. That is correct. But it moved 50 pips during that hour, okay? And within the hour came down 40 pips. It will print only 1 brick. Make sense? Can you again remind me how we can adjust the pips in the bricks? Yes, we will do that in a moment. Okay, great. Well, as I said, essentially the Japanese Renko is a variation of a line on close chart, because those charts are designed basically to filter out the market noise and give you a visual, a clean, clear visual that with a that you can determine the trend with a quick look. Traditionally, Renko bricks don't have shadows like the one that I'm showing you in my chart. But when you put them in your chart, they probably will have shadows. So all you have to do is, shadows are also called wicks. So all you have to do is to uncheck this. If we put that there, then they will be showing, see here, they will be showing the wick. And does it help us? Not at all, particularly because originally they never used that. What happened is that people needed them, and then were requesting the different software to have them available, and you will see that other softwares that offer Renkos won't have shadows. So my suggestion is that you take them off. It only tells us that prices move in a particular direction, but could not manage to move beyond our specified box size, which is the example I was giving you in a second ago to Adriana. So the first step to construct a Renko chart is your question, Esther, to choose a price unit that will become the size of the brick. So let's continue using the example of 10 pips, okay? Because, well, we have it in front of us, and well, let me get rid of this, and it's easy to count. So in trading view, we basically have two options, okay? When you first set it, you will see that there are two options here in the section box size, okay? The one is the ATR, and the other one is the traditional. Both are okay. Okay, basically the ATR, and we go very quickly through the concept of ATR. That's a relatively recent concept that was developed by Wells Wilder. Wells Wilder was the guy that developed the RSI and the parabolic SAR. And it's obvious that the old Japanese traders who created the Renko chart did not do anything based on ATR because, again, that's a relatively new concept. So using Renkos with ATR is also a new way of doing things. Does it mean that it's bad? Not necessarily. So now, why the ATR? Well, basically, ATR means the average true range. And what the average true range is a way to measure the volatility. So let's say we want to calculate the true range of a market over a 24-hour period. So that's extremely simple because all we have to do is to look at the extreme price range over a day. And we just look at the last bar and that's it, right? Let's say that prices were trading in a particular stock between $10 and $20. 10 would be the true range because the difference between 20 and 10 is 10, right? But that's the true range of prices for that specific day. Now we know that prices don't trade always in the same range. So if we want to have an idea of the average true range so we can use it for practical purposes, then we need to include more days in the calculation. And the 14 period is a typical number used for this purpose, and the number that has been used for this purpose in the last few decades. And that means about 3 weeks of trading, about 3 weeks of how that market went up and down. And that would give you an idea of the average true range during the past 3 weeks. So basically, the average true range is used as an indicator. For example, let's say that we go to stock. I'm not going to go too much into this because I don't think it's necessary, but let's say we go into stock here. Here we have the average true range. That's the indicator, the ATR. Yeah. So what does it tell us? It tells us that what this is Apple. That Apple average true range in the past 14 days has been about $6, right? So do people use this? Of course, it's normally used for position sizing, and especially people use it a lot for stop placement because let's say that now we know that this has been moving about $6, right, as a true range, and let's say that we are going to go short here because we believe this is an A, a B, and now this is coming down. Okay, let's say that. Well, then instead of putting the stop here or wherever we typically decide to put it, we use a $6 stop, basically. Yeah, because we know, or a $7 stop, because we know that the average true range has to change in order to get to us and stop us. So that's why people use it a lot for stop placement. I don't recommend that because it's basically a guessing work. So now, because the ATR is typically calculated over a 14 period, you will see that in your charting platform. Let's go back there. Let's use the same market we were using. I forgot which one was, but let's use euro. Okay, so this wasn't the one, but let's make it again a 10 brick so Adriana doesn't get upset. All right. So the reason is that I'm telling you all about this ATR thing is because when you get to your platform, it probably will be offering you the default settings of ATR. Okay, so what you do, there are several ways of using this. Okay, as I said, the original way was calculated with fixed sizes. Okay, that's the original way. The ATR is again the new way of using it. Can you use it only using the ATR? Absolutely, no problem. Here is the ATR. And in this case, notice that the ATR by default shows 20 pips. Whereas if we want to use the traditional size, what we have to do is typically go to the ATR first, like we just did, and then choose half of this. Okay, and that will give us, that will be a very easy way for us to have a convenient size, a convenient brick size. Okay, in this case it will be 001, right? So now we change this to traditional, and then we use 001, and there it is. That's the way. So you go first, you select the time frame. Obviously, in this case, let's say I'm doing 1 hour, but you can go 15 minutes. It won't change much. Sometimes doesn't change at all. This is the 15 minutes. You see, no difference. So let's say that you first go to your time frame. Um, Again, let's say that you use 1 hour or 15 minutes, and then you go to the ATR, and then you select half the size for the traditional. Okay, that will resolve the problems of seeing, well, how many decimals are there and all that. Either that, or you simply pick whatever size you want. You know, let's say that you want to risk very little, you want to scalp, instead of doing 10 bricks, you want to do a 10 pip brick, you want to do a 5 pip brick, well, choose 5. Very, very, very easy. Okay, so now to trade with them, I absolutely and totally recommend you to use it in combination with the top indicator. Absolutely. And if you want to improve your win-lose ratio, then you want to additionally combine it with the gap indicator. There's not much to explain about the gap indicator. I think with everything you know about moving averages, it speaks by itself. Now you can see very clearly. Well, just quickly, so you know, the gap indicators means these different moving averages basically uh, represent short-term traders and long-term traders. Okay, so when prices are above the long-term traders, the signals that you get are typically phenomenal signals. Okay, you notice this one, for instance. This was here we didn't have a signal, but here, let's say prices are already printing above the 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 moving averages, and this is a phenomenal um, signal. Okay, for instance, here, this is a phenomenal signal because prices are already below the gap indicator, and so those signals are unique. Now you could trade this one here, of course, but they won't work as effectively as the others, or they work sometimes, they don't work other times. Whereas these ones typically will work. I mean, you will have a higher win-lose ratio if you use that. Now, some of you have asked me if you can use it without the top indie, and the answer is absolutely yes, of course. You just have to decide how many bricks in one direction are sufficient for you to enter the market in that direction, and how many bricks will be required for you to exit a position if it goes against you. Okay, so I mentioned that earlier. With other chart types, it is difficult to know when to exit a position. That is, that you are in a winning position, but the position is going against you. So with Renkos, that's not so difficult. You just wait for, again, 2-3 bricks. That's probably sufficient. Some people exit their position as soon as they see an opposite brick appears. Okay, because as you can see, sometimes you can get a lot of a chunk without a single brick in the opposite direction. So if they are, let's say, if they are short here, then they will exit here. If they are short here, they'll exit here, and so forth and so on. Not so sure if that's a very good idea. I think it would be silly to use one brick to exit your position because, well, you know that all positions retrace. So 2 bricks sounds more logical, but we all know that in every trend there will be corrections, and those corrections retrace maybe 38%, maybe 50%, maybe 62%, depending upon what wave we're trading. You want to keep that in mind. So if you are trading a third wave, which is what you probably want to be trading, then you don't want to be getting out with one brick, because one brick will be just enough retracement for that price to gain further power. So 2 bricks may be too little, but okay for those who are very conservative and are very afraid of losing their profits. 3 bricks is probably the most balanced approach. You can actually see historically in the market the brick size and time frame that you're trading, and then that way you can see which number typically represents a correction there. For instance, here we can see that it's okay to have 3 brick correction. You look at this, 3 bricks here, 3 bricks here. So when you are short all this time and you put your stop at 4 bricks, then probably you would be getting out 1, 2, 3, 4. You would be getting out here with the buy signal. But if you are using the top Indy, then you can exit your position as soon as the opposite signal appears, and that's a lot easier. It's probably the easiest approach to use top in combination with the gap indicator. Pretty simple. We just get really great signals many times over and over, but you have to get used to them. It won't happen overnight. This is something that you have to practice, that you have to get familiar, and you have to test. Because, for instance, the 1 hour chart may be too much for your patients. Maybe you may be getting anxious because, as Esther said, you don't know what's happening, right? And since you have been trained to become very analytical, you want to see what's happening, and this thing doesn't show you. So you probably have to always use another chart to know what's happening, right? For long-term investing, I would not recommend the use of Renkos, and for that we will be focusing on the next intensive. But for shorter term, Renko charts are probably going to be very advantageous for quick scalps as well as many large moves, risking relatively little. Because let's say that you go long here, let's say, okay, and you determine that three Renkos is the stop that you're going to use. Well, your stop will be here, or if you determine 4 Renkos, it will be here. So the stop is kind of established. You know exactly where you're going to go wrong, right? So you enter here, and this is relatively little compared to the type of trend that you can catch with this type of charting. Okay. Now there is another indicator that you can use in combination with this. You can use another market so we don't get bored of that one. This is also a 10-brick chart. So let's say another one you can use in combination is the RSI. Very, very good for this type of things, because it will help you determine levels of overbought, oversold, and levels of resistance. For instance, here, for instance, you see that the 50 level have been offering resistance, right? Here it penetrated a little bit and even went above the moving average, and that was only a prelude of what was coming. And when that was penetrated, you can actually trade that as a breakout, because one that is penetrated here is a breakout here as well. It gave you really few. This is 10, so 10, 20, 30, 40, yeah, like 60, 70 pips trade. So not bad for a scalp, right? And yeah, so this is a very good one. You can see how the moving average also help to serve as resistant, as support. It really helps a lot. So, and the penetrations of the 50. By the way, I never finish also the lessons on RSI, and we should finish this as well. But we're going to finish first the MACD. If moves brick per time frame chosen means that for 1 hour we'll use X? No, no, it's not. Time has nothing to do with it. The time there is only, you forget about time, okay? Only use the brick size. That's really what matters. What happens here, for instance, this lighter bar here, it means that prices have been moving lower, but haven't closed because we are using a 1 hour chart. Okay, so in order for it to print it as red, it will need to wait for the entire hour to pass because the brick is calculated on the close, not on the action that the price is doing. So let's put it in 5 minutes, or 1 minute, so you understand it better. If in 1 minute, let's say that that price move uh, 10 pips, and we have a 10 pip chart. Okay, then the 10 pips, the brick will be printed. Now let's see that in 1 minute, the price was one of those news. Okay, it actually moved 30 pips up, 40 pips down, and within that minute, it actually closed in the middle of the range of the previous brick. Well, no brick will be printed there. Make sense? Okay, so let's see. Based on the ATR per time frame, we choose the brick pips. Example, in 15 minutes pip break, we will have of the ATR of 15 minutes. That's correct. Because of course, in every time frame, you're going to have a different ATR, right? On 1 hour time frame, the break peak will be half of the ATR of one. That is correct. That is correct. Okay, so for instance, you know how ambiguous the Canadian be? And look how clear it is here that it's bearish, right? So this is very, very helpful. And you can see that this level here has been a very important level of support, right? From here, here. So we need these levels here to be penetrated and for prices to uh, move even lower.